Most people think investing is simple. Buy dividend stocks for safety, buy growth stocks to get rich. Here's what they don't tell you. Both strategies can absolutely destroy your portfolio if you don't know what you're doing. Today, we're breaking down the real difference between dividend and growth investing. Two approaches that seem opposite but might actually work better when combined. Why do some companies pay you every quarter just for owning their stock, while others reinvest every penny? What's the tax mistake that costs dividend investors thousands without them realizing it? And which strategy actually builds more wealth over time? By the end of this video, you'll know exactly which approach fits your situation, or how to use both without getting burned. Understanding dividend stocks. Think of dividend stocks like owning a piece of a profitable business that actually shares the profits with you. Every quarter, they cut you a check just for being a shareholder. Here's how it works. If you buy a $50 stock that pays $2 annually, that's a 4% dividend yield. Doesn't sound like much, but it can add up over decades. Different types of companies pay dividends for different reasons. REIT, real estate investment trusts, are basically landlord companies. They own apartments, office buildings, shopping centers, collect rent, and pass most of that income to shareholders. It's like being a landlord without dealing with tenant complaints. Just know that REIT dividends get taxed as regular income, not the lower qualified dividend rates. Consumer staples like Walmart and Procter & Gamble make products people use every day. Walmart sells groceries and essentials. P&G makes household products like detergent and personal care items. When the economy tanks, people still need to wash their clothes. These companies have predictable demand, so they can maintain dividends even during tough times. Utility companies provide electricity, water, gas, services people can't live without. They're heavily regulated but generate predictable income, making their dividends relatively stable. Big banks and financial companies make money from the spread between what they pay depositors and what they charge borrowers. When this business model works, they generate consistent profits they can share with shareholders. Here's where people mess up. They see a 7% or 8% dividend yield and think they found a gold mine. High yields can be warning signs. Maybe the company is struggling and the stock price has dropped, making the yield look artificially high. If the business is failing, that high yield won't matter when your investment loses 40% of its value. Bottom line, focus on sustainable businesses first, then worry about the dividend. Understanding growth stocks. Growth stocks are the complete opposite philosophy. Instead of paying you today, these companies reinvest every dollar back into the business to grow faster, capture more market share, or build the next big thing. You're basically betting that the company will be worth way more in the future. No quarterly payments, no steady income, just the potential for your shares to multiply in value. Think about companies like Tesla, Amazon, or Nvidia. For years, they paid zero dividends because they were too busy growing. Tesla was building factories and developing new models. Amazon was expanding into new markets and building their logistics network. Nvidia was investing in chip technology that would eventually power AI. The math can be incredible when growth stocks work. Amazon shareholders who bought in the early 2000s and held on saw returns that no dividend stock could match. Between 2009 and 2020, growth-focused companies drove the market up 330% over 10 years. But here's the reality. Growth stocks can be brutal when they turn against you. In 2022, many popular growth stocks dropped 50% or more. Netflix fell over 75% from its peak. No dividend payments to cushion that fall. Some growth companies eventually start paying dividends once they mature. Microsoft, Apple, and Google all spent years as pure growth plays before they started sharing profits with shareholders. The hidden tax problem. Here's something most dividend investors never think about. Every dividend payment creates a tax bill. Let's say you're earning $3,000 a year in dividends. Even at the favorable qualified dividend rate of 15%, you're paying $450 in taxes annually. That's $450 that can't compound and grow with your investment. Over 20 years, those annual tax payments add up to way more than just the taxes themselves. If that $450 per year had been invested at 7% returns instead of going to taxes, you'd have about $18,400 in additional wealth. That's the real cost of dividend taxation. Growth stocks have a massive advantage here. You don't pay any taxes until you actually sell the stock. Your money compounds undisturbed for years or decades. When you finally sell, you might pay capital gains tax, but all that time, your money was growing tax-free. There is a workaround for dividend investors: accumulation funds that automatically reinvest dividends instead of paying them out. This lets you benefit from dividend-paying companies while avoiding the annual tax hit. What the numbers actually show. Let's look at the real data. Since 1940, dividends have contributed about 34% of the S&P 500's total returns. That means roughly 1/3 of all stock market gains came just from companies paying shareholders and those dividends being reinvested. During flat decades like the 1970s, dividend income was often the only positive return investors saw. But growth stocks have their own success story. The longest bull market in history ran from 2009 to 2020, with the market gaining 330%, primarily driven by growth companies. Tech giants like Apple, Amazon, and Google created wealth that traditional dividend strategies couldn't match. Here's the catch: both strategies have also failed spectacularly at times. During the 2008 financial crisis, many safe dividend stocks cut their payouts by 50% or more. During the dot-com crash, growth stocks lost 70% of their value and took 15 years just to break even. The key insight: there's no guaranteed safe strategy. Both approaches work under the right conditions and fail under the wrong ones. Which strategy is right for you? It comes down to three things: your timeline, your risk tolerance, and whether you need income today. If you're young and won't touch this money for 20+ years, growth stocks make sense. You have time to ride out the volatility and benefit from compound growth. A 30% drop hurts, but you have decades to recover. If you're nearing retirement or need steady income, dividend stocks provide more predictable cash flow. You're trading growth potential for stability and current income. If you're somewhere in the middle, you don't have to choose. Many successful investors use both strategies, maybe 70% growth and 30% dividends when young, then gradually shifting toward more dividends as they get older. The biggest mistake is not having a strategy at all. Don't buy dividend stocks just because they yield 6%. Don't buy growth stocks just because they're up 50% this year. Understand what you own and why you own it. Most investors never figure this out. They chase whatever performed well last year without understanding the underlying business or how it fits their goals. Speaking of understanding what you own, everything I just covered is useless if you don't know how to research companies before investing your money. Whether you're evaluating dividend stocks or growth stocks, you need to understand the business fundamentals behind them. I'll be making a video soon breaking down exactly how to analyze any company before you invest. So make sure you're subscribed so you don't miss it. Which type of investor are you going to be?